That's right. Today we're going to be covering gold because I thought it would be pretty timely considering that gold has had a massive rise in value lately and also paired with fears of hyperinflation due to massive money printing operations. So here's what I'm thinking for today. First, we'll start with a brief history lesson on the backstory of gold, and then next we'll talk about 3 reasons why somebody might want to own gold, and then finally, kind of along the way, we'll be tying this together in terms of our current situation in our economy right now to see if it's a great opportunity to invest in gold. Gold is one of the longest running asset classes that has maintained its value over thousands of years. Going back to around 560 BC, some of the earliest coins ever made were minted in gold. This began a trend of creating coinage out of various precious metals, including gold and silver. People valued these coins largely because of the metals they were made out of. Gold had long been established as a precious and desirable item by the time it was made into coins. Fast forward to more modern times, in 1792, the United States government established what was known as the bimetallic standard, whereby every monetary unit in the country was backed by either physical gold or silver. Effectively, every dollar bill represented either gold or silver that was held at a bank, and many other countries around the world were doing this as well at the same time. But by 1971, the United States abandoned the gold standard, which effectively meant that money no longer represented a quantity of gold. It was simply just money. This began our current era of fiat currency. Fiat in Latin means let it be. And fiat currency basically just means that it's a form of money that has no intrinsic value on its own. For example, really early forms of money were things like cattle or crops, which obviously have intrinsic value because cows and crops are useful, you can do things with them. But fiat currency, you can't really do anything with it other than use it as money. Despite this change, gold has still maintained a high level of importance in society and continued to maintain its purchasing power. If you're unfamiliar with the term purchasing power, you can kind of think of it like this. If I had $1 today and that $1 could buy me a bottle of water today, then if I were to fast forward 50 years from today and still be able to use that $1 to be able to buy 1 bottle of water, that means that that $1 maintained its purchasing power. And so gold has effectively been able to do this over long periods of time. It's worth noting that currently, the central banks of the world hold about 17.2% of the world's gold supply, and according to the 2020 Central Bank's Gold Reserve Survey, 20% of central banks in the world say they intend to increase their gold holdings this year versus just 8% who said they would in 2019. So consider that for what it's worth. So I think that brief history lesson actually provided us with some good clues as to why somebody might want to own gold. Now there's 3 specific reasons that I want to identify and then talk about with you today. And those are gold being a long-term store of value, gold's performance during times of crisis, and gold's diversification properties. Let's start with gold as a long-term store of value. What does that mean exactly? Let's take a look at an example. In the early 1970s, an ounce of gold was worth about $35. At that time, $35 would be enough to buy a new suit. If we fast forward to today, $35 is enough to maybe buy a t-shirt at best, definitely not enough for a suit. But an ounce of gold is now worth just over $2,000, which still makes it enough to buy a brand new suit, and a nice one at that. This represents the general relationship between gold and inflation. Generally speaking, over long periods of time, normal money tends to lose its value due to inflation. Remember when we were talking about purchasing power earlier? your dollars will actually become worth less over time, whereas gold actually tends to hold its purchasing power over very long periods of time. And ultimately, this is one of the main reasons why people buy gold, because they expect that it will maintain this purchasing power and be a hedge against inflation. They'll expect that if that ounce of gold can buy a nice set of clothing, like a suit today, they expect that in 50 years, it'll still be able to do the exact same thing. But this idea is a little bit more nuanced. So why don't we take a look at some actual data and evidence to see how gold performs as a hedge against inflation. In an academic paper titled The Gold Dilemma by Claude Erb and Harvey Campbell, they examined the data from 1975 to 2012 to see what gold did relative to inflation. This was an interesting time frame because the United States had just ended the gold standard in the early 70s. They found that because the price of gold was so volatile, it was not an effective hedge against inflation. So in other words, because the price of gold actually moved up and down quite a bit over periods of time, it meant that it wasn't always a good hedge against inflation, because sometimes you'd have periods of time where gold was actually declining in value even though inflation was continuing to increase, which means that your gold would have lost its value. And you would have lost even more money than just holding cash instead. As you can see in this chart, the price of gold has moved up and down quite a bit over the last 100 years. Now keep in mind that I'm adjusting this chart for inflation, so we can see what the actual real price of gold or its actual purchasing power would be at different points in time in the past 100 years. And you can see that it's quite volatile. It moves up and down quite a bit. However, in the paper, they found that if you stretch the timeline really far out, going all the way back to around 27 BC, they found that if you check and compare with the records of military pay at that time in gold and then compare it to the value now, gold would actually be a pretty good hedge against inflation and maintain its value. So in summary, the evidence basically suggests that if you're planning on living for a few thousand years, or maybe you're planning on passing down some large amounts of generational wealth, then it might not be a bad idea to have some of your money in gold, as it appears to be a good hedge against inflation over very long stretches of time. But if we're talking just shorter lengths of time, like 1, 5, 10, or even 20 years, it's not actually very clear that gold's necessarily going to be a good hedge against inflation. It might actually lag behind it over some periods of time. So if you're someone who's concerned right now about massive inflation in North America or currency devaluations, make sure to take this information into account before you make your decision. Now let's turn our attention to the second reason that somebody might want to own gold: its performance during times of crisis. I'm sure a lot of you are watching this video because you're probably a little bit concerned about our current economic situation right now and all the talk of money printing going on in the news. So your concerns might be including, but not limited to, central banks are printing way too much money, too much quantitative easing, keeping interest rates too low, propping up the stock market, devaluing the US dollar, racking up way too much debt, and causing massive runaway inflation. Before we dig into the evidence around how gold performs during times of crisis, I just want to make sure that we're actually clear on what is meant by when we hear things like the central bank is printing money. I think that this topic gets confused a lot by people, myself included. I didn't fully understand what that meant, and it's a bit of a confusing topic that you really have to dig into to find the right information that spells it out accurately for you. Now, this topic definitely deserves its own video, but I just wanted to try and clarify a few points on it. The first misconception that I would like to clear up is that central banks create new money, and that's because they don't. Central banks don't actually create any new money that gets added to the money supply. In fact, the only way that new money gets created in our society is through private banks making loans. And private banks can actually create as many loans as they want, as long as they think that loan is going to be profitable. And that's because we don't actually have a fractional reserve banking system. I know a lot of people think that we do, but we actually abandoned that a while ago, which means that private banks can create as many loans as they want to. And when a private bank creates a loan, they create a matching deposit in that customer's account who took the loan, which essentially creates new money in our financial system. Therefore, the only quote unquote money printing going on in our society is private banks making loans. And when you hear the term quantitative easing in the news, all that means is that it's just a larger scale of open market operations. Now, if you're not familiar with open market operations, basically central banks do this on a regular basis. This is a completely normal thing that they're always doing. And they use open market operations to try and control interest rates. So what a central bank does when it's doing an open market operation is essentially they're either buying or selling government bonds, because by buying or selling these government bonds from private banks, this can affect the benchmark interest rate that they are trying to control. But no new money is created when they do this. It's just simply an asset swap, and that's because the central bank will take bank reserves and use them to buy government bonds. So then on the balance sheet of a private bank, they're just receiving reserves instead of the government bonds that they formerly held. It's an asset swap. No new money is actually created there. Now, quantitative easing is just a larger form of open market operation, which means that central banks are just going to use larger amounts of bank reserves to purchase longer dated government bonds to try and affect long-term interest rates. So remember, open market operations are done to try and influence the benchmark interest rates, and quantitative easing is just simply trying to affect longer-term benchmark interest rates. And again, no new money is created when this happens. The only thing that creates new money in our society is private banks making loans. And a private bank will always make a new loan as long as there's demand for that loan and the bank thinks that they're going to have a high probability of making a profit on that loan. I strongly suggest that you don't just take my word for this and that you do your own research to basically see for yourself. So a good place to start with this, I think, is looking into endogenous money creation, and a great place to start on that is a paper that was released by the Central Bank of England called Money Creation in the Modern Economy. I also actually did a video where I touched on this topic, so you can watch that by clicking on the pop-up here or there, I forget where it would be. So let's bring this back to gold and talk about its performance during times of crisis. If we examine our two most recent crises, starting from the Great Recession in 2008, stocks declined by about 40%. During the same time, gold increased by about 5%. Fast forward to our current crisis we are moving through, and we can see a similar trend. Gold has been on a steady climb since 2018, and that climb has steepened over fears of our current recession. So this could suggest that it performs positively in times of crisis. But something I would point out here is that despite passing through multiple crises, if we look back at even the last 50 years, we've gone through 6 official recessions and stocks have returned about 3,200% versus just a 664% return for gold. And according to this 100-year chart of gold prices adjusted for inflation, the only time gold actually increased in price relative to inflation during a recession was in the Great Depression of the 1930s. Otherwise, gold remained relatively unchanged or even decreased in value when we take into account inflation. Last but not least, even in times of hyperinflation, gold doesn't necessarily come to the rescue. In the academic paper I previously referenced, The Gold Dilemma by Campbell and Erb, they found that when Brazil experienced hyperinflation of 250% per year from 1980 to 2000, the inflation-adjusted price of gold dropped by 70% at the same time. Gold's real value actually stays really consistent across the world at the same time, so if you were an investor in the US who purchased gold at that exact same time, you would have lost 70% on your investment as well. Now, if there is massive hyperinflation that's, 250% per year, gold decreasing by 70% is better than your currency decreasing by essentially 100%. But it's still not really clear that that makes it a great hedge in times of crisis. it's not the perfect safe haven that some people tend to make it out to be. So based on the evidence, I think we can say that it's not actually very clear that gold is going to perform well consistently in times of crisis. Over short periods of time, sometimes stocks will have a dramatic fall in value, and then gold might increase, pretty modestly or even have a decent increase. But following that, stocks tend to far outstrip gold. Now, if you have any cases that you'd like to raise where you've seen gold perform really well in certain times of crisis, I'd really like you to share them with me in the comments down below. We can all work together to try and improve our collective understanding around this topic. The third reason somebody might want to add gold to their investment portfolio is for purposes of diversification. When we diversify our investments, ideally what we're looking to do is reduce our risk while still trying to maintain that same level of return, as this results in a better investment experience. Investors commonly add small percentages of gold to their portfolios, something usually like less than 10%, as they believe that it provides really good diversification against other asset classes like stocks. So to determine whether something offers good diversification, a common measure we can look at is something called correlation. So basically with correlation, what we're looking for is something that has a negative or very low correlation with other asset classes. If something has a negative correlation, that means that it's generally going to be moving in the opposite direction of the other thing that it's being paired with. So for example, if I was looking to build a portfolio with apples and oranges and was hoping that they would be diversified against each other, I would hope that an apple and an orange has a negative correlation, which basically means that sometimes if apples are up, oranges might be down, but then when apples are down, oranges might be up, so that they kind of balance each other out that way. But hopefully over long periods of time, both apples and oranges will have positive expected returns. In the paper, Urban Campbell found that 83% of the time stock returns were negative, gold returns were positive. Additionally, from the period ranging 1988 to 2019, gold had a correlation of 0.085 with stocks, according to the MSCI All Country World Index. So this is a very low correlation, but it's not quite in the negative territory, which means that it may offer some good diversification against something like stocks, but it's not a perfect pairing because it's not negative. With that being said, Ray Dalio's famous all-weather portfolio is an example of an investment portfolio that contains a small allocation of 7.5% of the portfolio to gold for diversification purposes with the intention of performing well through various economic climates, hence the name. In a backtest covering 30 years between 1984 through 2013, the portfolio returned 9.7% per year net of fees and only had 4 years with negative returns. The worst negative year was only down 4% in 2008. Now that sounds really impressive. But when we consider that during that same time period, the S&P 500 returned 11% per year and long-term government bonds returned about 10%, a simple balanced portfolio of stocks and bonds would have performed about the same, especially when we consider both portfolios had a standard deviation of about 7.6 and 7.8%, which is virtually the same. So as you can see, gold is a really exhaustive topic covering so many different things, and honestly, I'm not quite satisfied with just one video on the subject. So if you found this video helpful, or maybe if it even challenged your current understanding of gold, give it a like and subscribe, because in my next video, I'm going to be pitting the views of Warren Buffett against Ray Dalio, and I'll also be walking you through some of the different ways that you can actually invest in gold if that's something that you want to do. And so with all that being said, I'm Steve Antonioni, and this has been Cash College on Gold. Thank you all so much for watching, and I will see you again soon.